There we are. We're live. Yay!
Welcome, everybody. Woo! Yay!
Yay! And Jennifer Hammond, we're here, coming from different sides of the United States. I was saying, it's beautiful here.
Oh,
Of
it's
course,
beautiful. I have
it's beautiful.
massive trees outside my balcony that are just in full bloom, right? Oh, it's beautiful out here today. So, we've been in snowstorms for 4 months, right? So,
Exactly. So it's the time. So let's go ahead. Let's tell people, let's talk about the good credit score. People, this has been in the news a lot the past week. If you have a good credit score, that it's going to hurt you when you're going to get a mortgage. So talk about that and how that in the big picture with fundability, what does that really mean?
All right. So first of all, let's talk about what's the background of this. The FHFA, right, the Federal Housing Finance Administration, it's the umbrella organization over the VA, over FHA, over Fannie and Freddie, all the government-backed securities. So that means that the government will pay lenders to lend money and will backstop any failures, right? Now, that's why during the failure in 2008, 2010, there was a $95 billion bailout because they had to pay back all of these banks because they had promised to do so. This comes from a reimbursement fund held by the FHFA, right? And so this FHFA holds this vast pool of dollars in order to backstop these failed loans, right? And so that's what the bailout was in 2008, 2010. Now so what they're doing is figuring out ways. Now they did something subtly different about a year and a half ago during COVID, but they're figuring out ways how to fund the fund, right? How to put money in this fund. And so they have set up a matrix of fees in order to, and drop the link in the Facebook or otherwise. Drop the link for that article. Very good article. But they've set up a matrix of fees where some go, depending on credit score, the fees go a little bit higher. This is not interest rate. These are fees inside of a loan. And so the rates, as your score goes up out of this, 640 is the floor-ish, right? 640 is the floor, but then it goes up to about 780, and then above 780, it caps out again. So this 720 to 740, 760 range has a slightly 0.75%. That's 0.075%, so minuscule amounts. But we're doing literally millions of mortgages a month for very high value. Compared to 2, 3, 5 years ago, the value of homes nationwide mostly have gone up, right? So they're cherry picking good credit score people to be able to fund this fund for the failures. Now, there's actually some lower costs for lower score individuals, but it's still 680 to 660. 680 to 660, the score, they're actually lowering some of those fees. And when they lower fees, lower interest, etc., it's always so that the new rates and the new payments of a mortgage are attractive to borrowers. So, and just so everybody knows, there are more 680 credit scores, you guys, than there are 740 credit scores. So they're trying to get more people buying homes, because that is one way in which you get out of a recession, is to create more traffic in mortgages, in automobiles, in purchases. Get the money flowing instead of everybody hoarding the money and trying to weather the storm. We want to get our sailboats out there, and the storm will calm down the more sailboats that are on the ocean. Horrible metaphor. There you go. Let's put our sailboats out into the storm, and it'll calm the seas, right? But in effect, that's what happens. So the storm calms when we keep money moving instead of we're holding it. So that's what's happening out there. And they didn't make a big, huge announcement. They kind of tried to do it under the table, but there are too many watchers out there, right? Too many watchers that are able to see what's going on. And the FHFA is this governing body that mandates how. In fact, if it's the FHFA who said, all right, we're going to start taking a look at FICO 10 credit scores, because they've been using FICO 542 for 20 years, right? 30 years. Now they're evaluating over the course of the next 18 to 20 months. They're going to evaluate FICO 10 and Vantage 4. And they're looking, and then they're going to dictate which score to use, just like it's the FHFA that dictates the middle score. You have to give rates based on the middle score, not on the average, not on the lowest, not on the highest. They are the ones who dictate what the rates are. The same thing, FHFA is going to dictate whether they're going to use a Vantage, which will be the first time in history that Vantage becomes actually a score player in the American financial markets, right? It's always been FICO.
For those who have followed us forever, we talked about that. It used to be what we called the fake score because nobody ever used it, right?
Correct. So now, excellent. And so we still define FICO scores by if a lender doesn't use it, it's a fake score. But now they're encroaching with mortgages first, and Vantage will not be a FICO score inside of the mortgage marketplace. But if they're using Vantage 3 on Credit Karma and you pulling them up FICO, so when you do an app, that's still bait and switch. So we will keep you apprised every step of the way. In fact, the fundability app that we're building, right? The fundability score app, getfundablejennifer.com. You'll learn all about this. The fundability score app that we're building actually has it shows in the score profile what Vantage scores and FICO scores and other non-relevant scores, so you can determine which if it's being pulled. We have a matrix of FICO and FICO, right? So my job is to make sure you know what time it is, not how the clock works, right? Yeah. So even though we're going to give you behind the scenes of what's going on there, so we'll keep you apprised. But FICO, if lenders don't use it, it's a real score if lenders do.
I love that. That's a great way. We're going to show you what time it is, but not how the clock works. So, but the basics that people need to know is in this course. So go to getfundablejennifer.com. I highly recommend this course. And of course, as always, Merrill, thank you so much for your insights this week. And hopefully we'll be on next Wednesday, as same time, same channel.
Actually, next Wednesday, yes, we will, because I'm going to be in Sarasota, Florida, in your neck of the woods. And the week after that, I'm going to be at FICO in Miami. So
that's right. Okay.
So we got this.
Yeah, we got this. So we're going to keep on keeping on and giving you the latest, greatest, especially with the FICO. That's amazing that they actually allow you in. Talk about it. Feels like you've gone to Oz and you went behind the curtain when you go there. So.
I remember last year in May, you and I were back there together, and we did this live side by side. So yes. I know that's a little ways from you, but if you happen to be in Miami, it's actually Hollywood. But don't Hollywood, cross Florida. The spot. Yeah. Don't cross.
All right. Well, maybe I will. Okay. Well, let's say goodbye to everybody. See you later.
Everybody.
We'll see you next week.
See you later. Bye now.